Hey everyone, happy Thursday, March 28th. It's about 10:20 on the West Coast and time for another market update. Coming to you live from Southern California. I'm down here visiting family with my daughter. Gonna go to an amusement park here in a bit and risk going on some roller coaster rides. But, luckily mortgage rates, stayed pretty steady this week. We didn't have too much of a roller coaster ride like I'm gonna go on. So getting right into it, first thing we got was February new home sales. Came a little down month over month at negative 0.3%, still up 5.9% year over year. And again, this is new construction signed contracts in the month of February. Another key thing to keep an eye on right here is the median home price went down 3.5% month over month to 401,000. All the mainstream media is making a big deal about this. Home prices are falling, but really this is just has to do with the mix of builds that builders are building. Builders are building a lot more lower priced homes on the scale, and less higher priced homes. And so that's why the median's coming down. Doesn't mean home prices are falling too much. It just means the builders are, trying to fill that gap and build some more affordable homes for folks. Another thing, keep an eye on this. There's only 85,000 complete out there. It's not a big amount of inventory. There's a lot under currently being built, but if you or I wanted to buy a house right now that's ready, it's only about 85,000 out there. Next thing we got was February pending home sales. Those were up 1.6% month over month, which beat expectations, which was really good considering, in the month of February, rates got above 7%. So these are signed contracts in the month of February. Doesn't mean it closed in February. So probably closing here in March or possibly even in April. So again, considering everything that's been going on, negative 7% year over year is really not too bad considering we know there's not a lot of inventory out there, not a lot of existing homes for people to buy. Rates have obviously not helped too much for people. So, the housing market's staying pretty strong given all that's happened. Next thing we got this week was January's Case-Shiller and FHFA appreciation numbers. So those, again, came in pretty rock solid given all that's been going on. Case-Shiller is the gold standard. FHFA removes jumbo and cash deals, so it tends to be a little bit lower priced homes. Take a closer look at Case-Shiller. Case-Shiller, up month over month, 0.4. I believe the seasonally adjusted number was negative 0.1%, which is the first negative since last January. But again, January tends to be a slower time of year with appreciation. Negative 0.1%. I believe last January was negative 0.5 or negative 0.6%. So again, negative, but really, really close to being flat, and really not much change there. And then year over year, we're at 6.6%, not seasonally adjusted. So again, home prices good for current homeowners. Not necessarily good for people that want to see home prices fall where they get cheaper for them, but good for current homeowners and good for the real estate, the health of the real estate market, and really the health of our economy. Next thing we got was initial job claims. Initial job claims came in, again, lower than expected. 210,000 new claims, where 215,000 were expected. Again, this is very important. The Fed is paying really close attention to jobs and inflation. With job market staying strong, Fed feels confident they don't have to cut rates as soon as they can. As soon as we want them to do, at least. Continuing claims went up a little bit, but again, we got to keep an eye on that because the Fed is keeping such a close eye on it. Next couple things we got here. So CoreLogic. A couple different things from CoreLogic. I did see that they do their loan performance, so how people are doing repaying their loans. Those are still seeing at really good numbers. And then the main thing I want to share was, again, CoreLogic, they do their blended rent year over year change. So this is blended rent, meaning it's new rents and renewals, and that's at 2.6% year over year. Whereas these shelter numbers that the Fed is using to calculate their inflation numbers, that's still at 5.7%. So if we just, split the difference here and came in, what if we were doing real-time numbers, core PCE would be closer to 2.2%, which is a lot closer to that 2% number that Chairman Powell always talks about. So, it's good that we know we're going to get some, we should have some positive movement in our direction, going forward. But it would be nice if it was a little bit more, up to date and we were getting a little bit more real-time numbers. But, that's how the Fed does things. And then, like I said, the final reading for the Q4 GDP came at 3.4%, a little bit higher than expectations. I think it's supposed to be plus 3.2%. A reason this is important, Fed can look at any sort of positive economic data and say, hey, the economy's doing fine. We don't have to cut rates. And we want them to cut rates as soon as possible. So again, we would like to see the economy growing. We like to see it doing well. But if it does too well, we're going to see rates stay elevated for longer. Next thing, so the average 30-year conventional just dropped a little bit from 6.96 to 6.91. Good to see it stayed under 7. Good to see it kind of staying not too volatile. But again, we definitely want to come down from there. We want to get closer to 6. But like we've talked about, probably not going to happen until we get closer to either we're very confident the Fed's going to cut rates and the markets know that, or that actually happens. So important dates coming up. We got tomorrow's a really big one. Is the PCE, is the Fed's favorite form of inflation. Like we talked about, they're really paying close attention to that core number, which takes out gas and food prices, energy and food prices, and they want that core PCE number to come down to 2. We're not really expecting a lot of movement down in that PCE report, so fingers crossed. Doesn't come in higher than expected. The way these numbers work, we're replacing numbers from last year, the year-over-year numbers, and they were pretty low last year. So we don't have a big number that we're replacing. We have a pretty low number. So, like I said, fingers crossed the markets don't freak out too much. And then next week we got the BLS jobs report. We know how important that one is, how volatile that's been. So that's going to be a big one next Friday. Then another inflation report, the CPI in early April. And then we don't have that next Fed meeting until May 1st. And we're, unless data comes in our favor, probably not going to cut May 1st, probably looking at June. But if we see those inflation numbers coming lower than expected, if we see that BLS jobs report start to jump up, that's when we can hopefully expect, maybe the Fed to pivot a little bit and maybe go to their cuts a little bit sooner. So, like I said, good to see the housing, whether it's new home sales, pending home sales, appreciation, that's staying really strong given everything that's going on. But for me, for new buyers, everybody looking to refi, we'd all like to see rates come down a little bit quicker. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, I hope everybody has a great week. Thanks a lot, everybody.